Adani Power just released its earnings for quarter one fiscal year 2026. So let's check out these earnings. Okay, so first we have the O&M availability. O&M means operation and maintenance availability. This basically shows how long is a power plant actually functional? How long can it be used? So 88% of the time, it seems that the power plants can actually be used in quarter one of fiscal year 2026. This is a big decline from 95% operation and maintenance availability seen in quarter one fiscal 2025. But in the notes, it has mentioned here that above 90% operations and maintenance availability maintained in most plants with purchase power agreements tie-ups. Okay, next we have PLF, plant load factor, which tells what percentage of total capacity is actually being used. So 67%, which is a big decline from quarter one fiscal 2025's 78%. But the reason here is given that reduced plant load factor is due to lower power demand following early monsoon. So it seems there were early monsoons and this affected the power demand because there were cooler temperatures and people required less electricity for, let's say, fans and all. Here we have the dispatch and the performance. Dispatch performance, which basically how much power they actually sold. So they sold 24.6 billion units of electricity, which is a 1.6% rise compared to quarter one fiscal 2025. And here we can see the sales volume mix. 77% is contracted in terms of long-term or mid-term power purchase agreements, and 23% is in short-term agreements. So 23% of power is being sold in short-term agreements. And here we can see the lower plant load factor at the Udupi affected the contribution of power purchase agreements in quarter one fiscal 2026. Udupi is their new power plant. It's a new thing. It's a new thing they've acquired. So of course it will take time to adjust. Here we have the revenues and the financial highlights. First, we have the continuing revenue, which has declined from 15,502 crores in quarter one fiscal year 2026 to 167 crores. Here we can see revenue affected by lower merchant tariffs and import coal prices as compared to quarter one fiscal year 2025. So merchant tariffs, or the rate at which power is sold in short-term markets, declined, and the import coal prices, I guess, were comparable or even higher. So coal prices higher, which means raw material prices are basically higher. Here we have the EBITDA. EBITDA has declined from 6,290 crores to 5,744 crores year on year, and profit after tax declined 15% from 3,913 crores to 3,305 crores. Here we can see quarterly profit after tax affected by lower EBITDA and higher depreciation on account of recent acquisitions. So they made some recent acquisitions, and because of that, there was higher depreciation. Here we can see too, EBITDA was affected by lower revenue, elevated operating expenses on account of recent acquisitions. So at these acquisitions, it will take time for revenue to come, the acquisitions to be as efficient as the continuing assets are. Moving on, we have, yes, the current operating capacity. Okay. So the current operating capacity is 18,150 megawatts, India's largest private sector ones. Uh, and they plan to add in 12,520 megawatts by 2030. So by 2030, they want to have a total capacity of around 30,000 megawatts. And here we can see the actual quarter one performance. Revenue declined by 6% year on year. Yeah, 6% decline year on year. EBITDA continuing declined 9%. and profit after tax declined by 15%. Gross assets 1,11,215 crores. Moving on, we have the one and only, yes, snapshot of profit and account, profit and loss account. Okay, uh, fine. Let me zoom out a bit. Yes. So first we have the effective capacity. This increased from 15,250 megawatts last time, 12 months ago, and now 15.1% growth in capacity, becoming 17,550 megawatts. Continuing operating revenue, we have other continuing other income. So total revenue reported was 5.8% lower. And here we can see other income section. This is increased by 39%, and this has offsetted some of the losses. We can see fuel cost has declined by 7.5%, but other operating expenses have increased by 29.6%, which leads to an EBITDA decline of 8.7% for the quarter. Here we can see finance cost increased by 5.6%, and overall profit after tax has decreased by 15.5%. So profit has declined, revenue also has declined, but why? We saw some of the reasons. One of the reasons were that India had lower power demand for this quarter when compared to like 12 months ago. We can see here, yes, steady sales volume despite demand variability due to comparative assets and operational excellence. Basically, power demand has decreased, but they still managed to sell a little more power than compared to last year. So that's a good thing. Revenues affected by lower merchant tariffs and lower import coal price. Impact on tariffs and some of the power purchase agreements. So there were lower merchant tariffs this time. Here we can see operating expenses and depreciation have risen only due to the addition of new acquired assets. EBITDA has shown resilience due to control on fuel costs and efficient recovery under power purchase agreements, and reduction in finance cost was seen despite new acquisitions and increased scale of operations. So all these things overall paint a very not that bad of a picture. Now here we see the debt profile. So gross debt. Gross debt stands at around 44,372 crores. Cash and cash equivalents 6,936 crores, giving us a net debt of around 37,437 crores. When we compare this to fiscal year 2025, it was 31,023 crores. So around 6,000 crores rise in debt. They have taken on more debt. Net. Moving on, we have the net debt to EBITDA, very important metric. We're comparing net debt, which is gross debt minus cash and cash equivalents, to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So this number of times, this figure you can see like 9.75 here, 9.18 here, that shows the net debt EBITDA. So in 2019, that was 9.75. So net debt was 9.7 times higher than EBITDA, which is concerning, or can be concerning. Then 2022, we had it at 5.74. As we move forward, we see 24, 1.41, very nice. 25, 1.44, and in quarter one of fiscal 2026, it stands at around 1.78. So net debt is 1.78 times of EBITDA. And we can see the ratings. Uh, Currently, all of them have rated it. So CareEdge, we have CRISIL, we have ICRA, we have, I think, IRR, India Ratings and Research. So all the major credit facilities, credit rating agencies have rated Adani Power Limited at double A stable. So overall, revenues declined a bit, profits declined even harder. They're still on track to add around 30 gigawatts or 30,000 megawatts of electricity by 2020. This quarter showed lower power demand and there were lower prices for electricity. So that led to overall decline in revenue. And also because of the new acquisitions, there were higher costs. With these higher costs and lower revenue, profits declined by 15%. And they also had a 1 to 5 stock split. Adani Power just announced a 1 to 5 ratio stock split, meaning every one share will now become into 5 shares, which means if you own one share, which is currently around 500 rupees, 560 rupees, it will get divided to around 120 something. No, not 120, 110 something rupees, but the total value will remain the same. This usually seen as a move to increase the affordability of shares to like new investors and like increase liquidity. And those are some of the reasons that are actually given. So I guess, yeah, that's it. Hope you have a nice day.